Welcome to Alu Speaks with Alu Patience. Today we'll be continuing our previous topic, financial analysis. This is from the course Corporate Finance. We are on Modules 2, the second and third topic. If you have not watched our previous topics, I would advise you to do so. However, I have realized that most of us do not have a business-oriented background, so I'll be breaking the topics down to be as simple as ABC. In our last class, we discussed the liquidity tools, profitability tools, and efficiency tools. Those are the financial ratios we discussed. Today, we are going to focus on leverage tools and investment tools. But before we continue, if you are just joining us for the first time, please subscribe, like and drop a comment or two if you need clarity. And don't forget to hit on the notification bell for future amazing topics. The leverage ratio. The leverage ratio is a ratio that measures the relationship between equity and debt. What I mean is, it measures the relationship between funds provided by the owners and funds provided by third parties. This leverage ratio is also called the gearing ratio. We mostly use this ratio to check the quantity of debt elements in our business capital structure. Some of the leverage ratio include the debt to equity ratio, the debt to total capital ratio, the long-term debt to total capitalization ratio, the interest coverage ratio, the total debt coverage ratio, the capital gearing ratio. We are going to discuss some of them. First, the debt to equity ratio. The debt to equity ratio is also known as the debt to shareholders fund. This ratio tells us how much debt the business has for each unit of equity. It is computed as total liability over total equity, and it is usually compared to ratio 1. That is total liability over total equity is to 1. 1 here represents the ideal ratio for equity, meaning that if our answer is 1:1, it means we are neutrally geared. But if it's 2:1, we are highly geared. The debt to total asset ratio. This measures how much of a business asset has been financed by total debt. It is computed by total liability over total debt is to what? 1. Now, the interest coverage ratio. The interest coverage ratio, it measures the business ability to pay up to meet its interest obligations as at when due from its operating profit. We all know that operating profit is profit before interest and tax. And lastly, on this group, we have the capital gearing ratio. Before we discuss the capital gearing ratio, let us refresh our mind about how capital is raised. We know capital is raised from shares and from loans. And these shares, they could be ordinary shares and they could be preference shares. Preference shares are those shares that carry a fixed dividend. Capital can also be raised from loans, that is, from debentures with fixed interest payments or long-term loans with also fixed interest payments. You would realize that every one of them I just listed here, apart from the ordinary share capital, they have fixed interest. That is, their owners always earn a fixed return. So what is gearing ratio? Gearing ratio, it tries to measure how much of a company's capital is provided by shareholders in relation to those provided by fixed returns owners. That is, we are trying to compare capital provided by ordinary shareholders against capital provided by owners with fixed interest returns. And like we said, 1:1 is neutrally geared, but 2:1 is highly geared, and 1:2 is lowly geared. And remember, when we are discussing about equity, we are not talking about just ordinary shares. We are talking about share premium included. We are talking about retained earnings included. We are talking about evaluation reserve and general reserve included. So when you are calculating your equity, you will check your financial statement to see if all these things are mentioned, so you can get the total value of your equity. The investment ratios. The investment ratios, they are also called the stock exchange ratio or the price ratios. These are ratios needed to make capital investment decisions. They include the earnings per share, the dividend per share, the price earning ratio, and the earning yield. Now, the earning per share. Before we talk about the earning per share, let us go back to what we said before. We have different types of shareholders. We have the ordinary shareholders and we have the preferred shareholders. The preferred shareholders, as we said previously, are those shareholders that are paid a fixed return first before the ordinary shareholders are paid from net profit. What I'm saying is that from net profit, preferred shareholders are paid first. So whatever remains are profit attributed to the ordinary shareholders. And that is the profit we use in calculating our EPS. Therefore, earning per share is what? Profit after tax minus preference share dividends all over numbers of ordinary shares outstanding. What do I mean when I say ordinary shares outstanding? I mean the numbers of shares the company has issued so far. And we know that the higher the EPS, the better the profit for the company. Now, dividend per share, as the name implies, is the amount of dividend payable per unit of shares. Therefore, it is computed as dividend paid all over numbers of ordinary shares outstanding. Dividend per share is asking the question if the company has enough dividends to pay. Let's note that dividend pay does not include dividend from extraordinary activities. I mean, it does not include dividends from one-off activities. All those type of special dividends, it does not include it. Price earning ratio. The price earning ratio is also called the PE ratio for short. It simply means market price all over earning per share. We know that market price can be gotten from the financial market. Market price is the amount a unit of shares is purchased in the financial market. This ratio is telling us how much the market is willing to pay for each naira earned. Now, the dividend yield ratio. The dividend yield ratio is simply the dividend per share all over the market price per share. It means for us to calculate the dividend yield ratio, we must have first of all calculated the dividend per share. This ratio shows the percentage of dividend earned on each unit of shares in relation to market price. That is the percentage of the company share price that the company intends to pay as dividend each year. Now for the nitty-gritty. Let's get our hands wet and dirty, because all work and no play makes Alu a dull girl. Now, this is our financial statement. Just looking at it, we can see something. We can see it's for 2 years, for 2008 and for 2007. So they gave us two financial statements concurrently together, which means this is a horizontal analysis. We are comparing the financial statement of 2008 with the financial statement of 2007. Now it starts with the fixed assets. The fixed assets were listed, and when we go scroll down, we can see the current assets there too. They are all listed. Then they list the current liabilities. After listing the current liabilities, so the finances, the capital employed in the company through the equity and through that then 10% debenture. Now we went to the P&L account, profit and loss account. It's also called the income statement. So we can see the sales figure here for the 2 years. Less cost of sales. Don't mind that land cost of sale. It means less, not land. Sorry for that. Less cost of sale. You can see the cost of sale there, opening stock plus purchase minus closing stock. That gave us cost of sale. And that gave us our gross profit. When we less expense from the gross profit, we can see the net profit, and we can see a provision for tax after the net profit. Then we see some transfers made to reserve and some proposed dividend. Oops, who else is seeing additional information? Why now? Okay, they said the market price per share for the 2 years. 2008 market price was given, 2007 market price was given. Anyway, it is not their fault. It cannot be in the income statement because the market price you have to find that out from the financial market. Then okay, number 2 note, they said expense include the debenture interest as follows. Why did they remove this debenture interest from the income statement? They should have put it there. But guess what? We will not forget. We all know that the debenture interest is here. So any questions that relates to it, we will come here and capture this figure. What will be asked to do? Let's look at the required. They are asked to define the following ratios, compute and comment on the ratios of the company. I have been defining it for the last 2 chapters. So we already know the definition. If you don't, go back and read it. Let us just compute. The first question says find gross profit margin, which means we will look for the gross profit margin for 2007 and the gross profit margin for 2008. And we know that gross profit margin, the formula is gross profit over sales times 100. Remember that the gross profit and the sales figures can be found on the income statement. So let's go there. Therefore, for 2008, gross profit is 858, while for 2007, gross profit is 722. Remember, all these figures are given in thousands, but it is for convenience sake, we are just shortening them. And the sales figure for 2008 is 303,680, while the sales figure for 2007 is 2,888. When you multiply them, you find out that the figure for 2007 is 25% and for 2008 is 23%. You can see that from 2007 we had a drop in our gross profit. From what I'm looking at, we made more sales in 2008 than 2007, so we are supposed to have made better gross profit. But I can see here that we could not control our cost of sales, that is shot up from 2,166 in 2007 to as high as 2,822 in 2008. This is the cause of why that gross profit margin reduced. Now let's move on. Net profit margin. Net profit margin is almost like gross profit margin, but the only difference we are using the net profit over sales times 100, not the gross profit. And from here, the net profit for 2008 is 164, and the net profit for 2007 is 116. And we will still use the same sales figure. For 2008 is 3,680. While for 2007 is 2,888 times 100. In 2007, you find out that we have a 4.46%, while in 2007 we have a 4.01%. There's an improvement in the net profit from 4.01% in 2007 to 4.46% in 2008. Kudos to us for this. This is a slight improvement. In the next one, we are asked to find the return on capital employed. We remember these profitability ratios that said the net profit before interest and tax all over capital employed. That is earnings before interest and tax all over capital employed. This earning before interest and tax can be gotten from our income statement, while capital employed it should be gotten from what? Our balance sheet. So let's go find them. I know some of you may say, but I'm not seeing anywhere they wrote profit before interest and tax on this income statement. Calm down. Our profit on the income statement is showing net profit before tax. It is not even showing any interest at all. Hold on. Let's remember that the accountant told us that interest on debentures was added to expenses in the additional note. For 2008, interest on debenture was 16, while in 2007, interest on debenture was 20. Remember, I said I'm just ignoring the triple zeros so as to make our work look a bit neat. And since the formula says net profit before interest and tax, so we need to add back the interest on debentures back to both net profit figures, because that interest on debentures was included in expenses and deducted before getting net profit. So the net profit we have in our income statement is net profit after interest, and what we need is net profit before interest and tax. So we need to add it back. Remember, our capital employed is gotten from the balance sheet. It is the total of equity and debt that was employed into the company. And for 2008, this figure is 1,010, and in 2007, this figure is 736. So when we multiply that by 100, we find out that its answer to 2008 is 17.8%, while that of 2007 is 18.5%. We can see there was a slight drop in return on capital employed from 18.5% to 17.8%. This is not something to be too alarmed about. It's just a slight drop. The next one is the return on equity ratios. As the name implies, returns over what? Equity. And the return is net profit after tax divided by equity times 100 over 1. And we remember that our net profit in our income statement was given before tax. And now return on equity was net profit after tax. So what does this mean? This means that we just need to amend it by adding the tax figure back into net profit to get net profit after tax. I guess you can see that the net profit was given before tax. Let's just amend it to net profit after tax by removing the tax ourselves from the given net profit. And you can see it there in the income statement that for 2008, the provision for tax was 36, and for 2007, provision for tax was 24. Therefore, for 2008, we see net profit of 164 minus provision for tax 36. And in 2008, we see net profit of 166 minus provision for tax 24, so as to get net profit after tax. We remember it's all over what? Capital employed in both cases times 100. Remember that our capital employed is made up of ordinary shares, reserves, and retained earning. That is the profit and loss they are allocated to the balance sheet. Now I'm a bit concerned. Why is the return on equity dropping from 17.1% to 15.1%? This is not what the shareholders want to see. The next question asks us to find the quick asset ratio. We know that the quick asset ratio is the same thing as the acid test ratio. And to find the quick asset ratio, we simply say quick assets all over current liability. By quick assets, we mean those part of current assets that can easily be converted to cash. Now, these figures can be found in the balance sheet. Now, looking at the balance sheet, we can find our total current assets there. But inside those total current assets, we know that stock cannot easily be converted into cash. We remove it. We also know that work in progress is not possible to convert work in progress to cash. We also remove it. So whatever you divide it by what? Current liability. Looking at for 2008, we can see that we got 0.89, and for 2007 we got 0.93. We can see that the company was able to convert its current assets to cash faster in 2007 than in 2008. The next question is asking us to find the gearing ratio. Remember, the gearing ratio is simply us comparing capital contributed by ordinary shareholders, that is the equity, with fixed interest capital contributed by other stakeholders. We can see from the computation that in 2007, the company was more highly geared than in 2008. This is a very good news for outside investors who want to give loans to the company, because nobody wants to give loan to a company that is very highly geared. Now, the sales to debtors ratio, as the name implies, is sales over what? Debtor. And we can get the sales figure from the income statement, and we can get the debtors figure from the balance sheet. We can see that in 2008, the numbers of times we were able to collect our money from debtors was about 16.6 times. And in 2007, the numbers of times we were able to collect our money from debtors was 18 times, which means we collected our debtors paid us faster in 2007 than in 2008. The debtors ratio. This is a ratio that simply wants to know how much of our total asset is being financed by debt. Therefore, it is total debt over total assets. These figures can both be found in the balance sheet, where your total debt, you add your current liabilities plus your long-term debt, that is your debentures. You add your fixed asset figure plus your current asset figure. So we can see that for 2008, we have 34.6%, and for 2007, we have a 45%. The next one is total assets to turnover ratio. They are simply asking us to measure total assets with sales. And total assets can be gotten from the balance sheet, and the sales figure can be gotten from the income statement. And we remember what we said. Total assets is what? Fixed assets and current assets. When you add them together, you get your total assets. Then you compare them with your sales figure. You find that in 2008, we got 1,300, while in 2007, we had 922. Remember, we compare it is to 1, that is where 1 represents the sales figure. So in this case, you put the sales figure there. So 1,300 is to the sales figure for 2008, and 972 to the sales figure of 2007. That will be our base for comparison. Earning yield. This is an investment ratio that compares earning per share over market price. This means we must first of all calculate our earnings per share. To calculate earnings per share, we simply say net profit after tax all over the numbers of ordinary shares outstanding. We remember that in our income statement, our net profit is before tax. So all we need to do is to remove tax from it to get your net profit after tax. Then compare it with the ordinary the numbers of ordinary shares outstanding, you find out that for 2008 we had an EPS of 0.21%, and in 2007 we had an EPS of 0.23%. Just imagine, this examiner has indirectly made us to calculate EPS. Now let us go to the real question they asked us to do, which is to calculate earning yield. And earning yield is what? Earnings per share all over what? Market price. We have already calculated earnings per share. We thank God. Now, market price. Remember, we can only get market price from the financial market. It cannot be in the income statement. So let's go back to those additional information where they wrote the figure of market prices for both years. Good. We can see that the market price was for 2008 was 1 naira 50 kobo, while that for 2007 was 1 naira 45 kobo. Now let's compare it against EPS for both years. You find out that in 2008 we ended up getting 14%, and in 2007 we had 15.8%. Earning yields have dropped from 15.8% in 2007 to 14% in 2008. Wetin dey happen now? Now the stock turnover ratio. The stock turnover ratio simply compares cost of sales with average stock. And we know both cost of sales and stocks are found in the income statement. Remember, when we say average stock, it means we are saying opening stock plus closing stock divided by what? 2 to get the average. Now, when we compare the data, we find out that in 2008, stock turnover was 10.33 times, and in 2007, stock turnover was 10.51 times. Now we have come to the end of financial analysis. What a wonderful computation. I'm sure we were all excited. This was beautiful. See you in the next class.